Chapter. We're talking real money.
Hey, welcome to Talking Real Money. I'm Tom Cock. Don has the day off. I got a special guest. No, not special. She's been here before, and many of you write and say you enjoy hearing her, so we're bringing her back. We'll talk about that in just a minute. Take some of your questions as well. We get a lot of them, and we try to answer them as best we can. So, but I want to start out first talking about people who are successful at investing. Because so many of you struggle with this. You struggle to find the right investments. You struggle to sort of stick with things. And you also get stuck sometimes. I see people that have portfolios and they think, it's good enough. I'll be okay. And we want you to do better than that. But so I read a piece recently where an interview of a guy named Roger Federer. Now, many of you who are not tennis fans might not know that name, but he did pretty well in tennis, actually. And they asked him to sort of compare that to investing success. In fact, Federer played 1,526 singles matches during his career, winning 80% of them. But in a recent chat, he asked people, what percentage of the points do you think I won in those matches? The answer, 54%. He won barely more than half of the points available to him. The magic came from that small, consistent edge that compounded into something extraordinary over time. And it turned out early in his career, he struggled because he was really good at the beginning of matches and not so good at the end. An opponent later said, Roger will be the favorite in the first few hours, and then I'll be the favorite after that. But what he found was he ended up taking the discipline to say, I'm going to focus on just how great I can be at the end of the match. Intense cardio workups, being sharper later in matches allowed him to take advantage of opponents' weaknesses. He talks about belief in himself, which really isn't that important to this piece, but the difference in winning and losing for somebody at the very highest level, I think, are some lessons for all of us. And the first one is, and our guest, our commentator, our chatter is Roxy Butner, who's an advisor to Pella Wealth, who's been on the program before. But we both read Atomic Habits, which talked about those little differences you can make in your life that can make you a difference between success and failure. And that is so true when it comes to investing. Small changes, small differences have a huge impact. Many of you look at your portfolio and say, well, 1 or 2% a year is not a big deal. That is a huge deal. And we can run that for you to show you that. So that's one, that pay attention to the little things that really do make a difference. Number two, discipline is truly everything when it comes to investing. Most people, they'll start out okay, they'll start investing, and then something will change in their life, in the market, or their feelings about things, or we go through an election and they don't like the person who won and they decide to make a change. Vanguard's study found that the majority of a difference a good advisor can make for you comes from behavioral. Making sure that you're invested properly all the time, making sure you're not reacting to things. And then the third thing I took away from Roger Federer was, in investing, you don't need to win. It's not a zero-sum game. You simply invest. You take advantage of the rising earnings, the rising growth of those firms. You stick with things that way, and you don't have to wake up in the morning and be just that much better than your opponent, because frankly, there are no opponents. Some people think there are, and you're going to do just fine. So make sure you're paying attention to those little differences. Make sure that your behavior isn't going to short-circuit all of your hard work to be an investor in the first place. So one of the things we try to do on the show regularly is answer your questions. You've got questions about a wide range of things. Roxy Butner is one of our advisors. She's been on Talking Real Money previously. Thank you. And by the way, Roxy deserves extra applause today because not only is she here to answer questions, she has to deal with me taking 25 minutes to figure out how to turn the computer on and plug the microphones in. So
every time like clockwork.
I know. So this time, my partner, Don McDonald, said, why don't you take a picture of, what a genius idea, of the settings, and then next time you don't have to call me and you don't have to get all frustrated. So Roxy, thank you for both being here and being so calming. She's like, oh, it's okay, it'll work, and I'm thinking I'm getting ready to throw the computer through the window. But we made it happen. We're here on Talking Real Money, and we're going to take some of your questions. So what's up first? You go.
All right. So we've got a question from Larry in Eagle, Idaho. This is an interesting one. So, Tom and Don, I enjoy your podcast while taking my daily walk. I have a question for you guys. All this talk about CPI and rate of inflation seems like just error-filled nonsense. What I care about is maintaining my purchasing power. Based on all available data, do you think the USD, the US dollar, or Bitcoin has a better chance of at least maintaining the current level of purchasing power 5 years from now? It just seems like the US dollar has zero chance, and Bitcoin has always increased its purchasing power over any 5-year period. Love to hear your objective position on the question.
Yeah, okay, let's talk a little bit about cryptocurrencies, which have been certainly in the news recently. They've had a great run here since our recent presidential election. Here's the thing I find fascinating about cryptocurrency in general. There's always a narrative of some kind. There's always a story that drives the price. It was that the blockchain was going to change the way we shop, the way we do business, all that kind of thing. And that goes way back, like 10, 15 years. That really has not occurred. I mean, we still kind of do the things we did before in the same ways. So that didn't happen. Then it was going to be cryptocurrency is going to be the global currency. This is going to be the way that we buy things from China or Russia. That has not happened. Now the new narrative is, well, we got a crypto guy in the White House, I guess, or you got supporters in the White House. By the way, that's not true in Congress. There's a lot of people there that have already said, I don't care what the president says. We're not going along with helping cryptocurrency along the way being more friendly. So what do I think? I would be, and by the way, the dollar's had a great run also since the elections, had a great run for really going back to 2008. I will continue to use the U.S. dollar. I will not be changing to cryptocurrency or Bitcoin for that matter. It still remains a speculative investment / asset. It's still not, I don't think, trustworthy when it comes to security. We've seen billions stolen. In fact, a family member was in a business where they took, I think they said $100 million was stolen from their company. So, no, I'm not a truster in cryptocurrency, but what is your take? Purchasing power, are you going to go with the dollar or are you going to go with Bitcoin?
Yeah, it's interesting because when you actually do look at the numbers, people on the other side will say that, yeah, the U.S. dollar has been declining since the 1960s in terms of purchasing power, and that Bitcoin, since the 13 years that it's been around,
13 long years now,
has increased by over 600% in purchasing power or something of that nature. I just think it's really important when you hear those numbers and you see the headlines, sure, that sounds great, but it's really important to keep in mind we're talking 13 years of history and data. And the volatility, we're forgetting about the volatility that comes with Bitcoin and its high cost to get in there. I mean, it's very expensive. All these things make it a risky investment and make it speculative, as you mentioned. And some people compare it to commodities like gold. But on the downside of the market, Bitcoin does react. And so it's not a stable kind of hedge of an investment.
Thank you. That's the one that I think people forget is, do you really want to have your dollar compared to the German Deutschmark of the 1920s or the, I forget the other currency in South America that goes up and down and on and on? No, you want your currency to be fairly stable. You don't want it moving around a lot. So that's another problem with Bitcoin is that it is all over the place.
Yep. So to answer your question of what do we expect in 5 years, the answer is no one really knows. And there's not enough history or data with Bitcoin to know for sure. So really, if you're worried about inflation and keeping up your purchasing power, the best way to do so is to keep a small amount of cash on hand and invest your money in the global market.
And call us again in 5 years, and maybe our opinion will have changed. But I doubt it. I truly do. Again, this is something we hear fairly often, and especially now, as I said, with a big run-up in the price of Bitcoin. Remember, there were people that said it was going to be at $1 million in 2025. We're still quite a ways from that number. So that would not be a change for me. What else we got?
Okay, this one is from David in Beaver Creek, Ohio. Hi, my company has dropped the Vanguard Prime Cap Fund Admiral shares expense ratio of 0.31%, ticker VPMAX, and replaced it with Nuveen Winslow Large Cap Growth CIT Fund, Class C, expense ratio a little bit higher at 0.45%. No ticker listed on the communications. I don't know anything about the Nuveen Winslow Fund. The company is also switching from Vanguard to Fidelity in September, so there will be many more changes in the near future. What is the best way to navigate when the company you work for changes 401k service providers?
That's a really good question, David. So, okay, first of all, going from Prime Cap, which is not a favorite of mine, to Winslow, that's a step down. I mean, that is not a good move. Winslow is an actively managed fund. They're picking stocks, and it's very expensive. You're correct, 0.45. Part one, generally when you get to these situations where the plans change and the options are not good, most of the time you can still find a target date fund that has a low expense ratio. So you could own that there. Then outside of that, you could invest in a Roth IRA. You could invest in a brokerage account that would give you some of the other asset classes, small cap value, international, emerging markets, some of those other places you need to invest. If it's actually a absolutely horrible plan, and I mean, you can stop doing obviously contributions into that plan, or you can lobby for better choices. And we've seen this happen where people have gone to their plan sponsors and said, why can't I just have a Vanguard index fund or a Vanguard total global fund and then a bond fund? Just give me that option. Companies have become more sensitive to all of this in the last 15 or 20 years because they get sued a lot. And so I'm really surprised that in this case, we don't know the firm, that they're moving to a more expensive and what I would call lousier pick.
I totally agree. Yeah, I was going to say all the same things. I think that one thing to remember too, though, is before you even get to that step, you have to understand the funds that are available to you. And I think it's surprising how little people actually know that you can just take these funds, look them up online, and you can determine at least at the bare minimum what the expense ratio is, what the size of the underlying asset class is, and whether you're invested in global markets or the U.S. market. So one thing I did here is we just go to Morningstar, for example, and you can look up both of these and do just a side-by-side comparison. So next time they change the funds, you can do this, with whatever new funds that they are switching out. So Vanguard Prime Cap is large cap blend fund. Easy to find that. We know it's 0.31% expense ratio. 85% U.S., 15% international. So there is some international.
Yeah, okay.
And it has 167 holdings in it.
Yeah, that's very narrow.
It's very narrow. But then get this, when you compare the Nuveen fund, it's all U.S. large cap growth, but with only 40 holdings.
Wow.
So you'd have to decide, which one is more diverse, lower cost, and at least targeting what you're trying to target. But as Tom said, if you're running into an issue where you're really finding that there's not good options, at least at the minimum, invest the match that your company will match.
Get your free money.
And then look at what your other options are. And I will say this, I think most financial professionals will help you with the 401k investments. So, find someone who you can trust, 100% fee-only fiduciary, and ask them if they can give you some advice.
That's really good. And our apologies. Those are not very good choices. And frankly, moving from Prime Cap, which I forgot does have the partial international exposure, to the Nuveen, those aren't even apples to apples because those are two different asset classes they're owning. I don't want to be in any fund that only holds 40 stocks. That's just a very thin. And my guess is half of the portfolio is in the big five, right? It's in NVIDIA, it's in Apple, Amazon, et cetera. And that makes me even more nervous because now you're betting on the things that have gone up the most the last few years. So, by the way, if you have questions, it's so easy to send them in to us. You go to talkingrealmoney.com and you can send them right from there. We're happy to answer them as best we can, and we try to give you our honest take on each and every one of these and spend time on them, like this one.
Right. This one was from George in Uxbridge, Massachusetts. Hello, Tom and Dawn. Your podcast is full of fun, but also very instructive. Thank you for the information and the laughs. I'm 61 years old and will start drawing on my portfolio in 5 years. Currently, I have $35,000 in an HSA, $295,000 in a Roth, $235,000 in a traditional IRA, and $1.5 million in a brokerage account. My portfolio was full of high-cost funds until I started following your advice. The housekeeping was easy in my IRAs and HSA, but the brokerage account is a little trickier. First, I sold all the high-cost funds that had losses. Then I sold high-cost funds with gains that washed away my losses. Now I have several funds with expense ratios hovering around 1% that have gains between $10,000 and $39,000 and hold between $22,000 and $82,000. So my question is this. If I will begin drawing on the brokerage account in 5 years, is there a simple calculation that would tell me, for example, if it's worth an $8,000 federal tax hit in order to reduce my expenses from 1.09 to 0.12% and release $85,000 into a lower cost fund. This is my situation in one fund. I'm in the lower end of the 24% tax bracket and could sell one or two of these funds without pushing me into the next tax bracket. But does it make sense to do this? Paying the IRS these taxes could conceivably decrease my Roth contributions. What would you do?
Yeah, here's what I would do. I wouldn't do anything. Because here's a couple things. At 61, my guess is you're still working. You don't say that, but it sounds like you are. You could wait until your income goes down to zero, for example. Then you have room on the capital gain side. I think all the way up to 70,000 before you have to pay anything in capital gains.
Married, filing jointly.
Yeah, so you just wait that out a little bit. Number two, you may never sell those. I mean, I don't know, because you just don't. With that situation, no. The question is there an easy way to figure that out? No, I don't, that I know of. Maybe you do, Roxy, but
No.
I would simply wait it out. I would be investing in other funds if I'm still saving into that brokerage account. I would wait out till I'm retired when my income is lower. Then you could consider, okay, I want to clean this up a little bit. Maybe you just leave those and build around them. But what's your take?
Yeah, or maybe those are the assets that you sell first to create your income in 5 years.
There you go.
So it really does depend on your personal situation. I like the thought process here. You went through all the right steps. The IRA is obviously easy to rebalance in there into lower cost funds. With the taxable account, you did do some offsetting of gains and losses, and also keep an eye on the account over the next 5 years, because you might have new opportunity to go in and take some losses and offset them with gains from selling some of these high cost funds. But yeah, especially the part about, this could decrease your ability to contribute into the portfolio. I certainly wouldn't make a change that would leave you with a big tax bill and reduce your ability to actually get more money into the market.
This is one of those things, too, around that I think is strikingly similar, and that is Roth conversions. People always think it's a no-brainer. My initial take, by the way, on that question was go see an advisor, because there's enough complexity here at 61. I got this much pre-tax, this much post-tax. I'm going to need this much income. That's where you really get an advisor involved that runs the income, how to get it, where the most tax efficient manner, how you should be invested in each one of those accounts, because it should be different. And then whether you can start to clean things up. And in many cases, as I said, many people come in the door just I want to do these Roth conversions. I think, that should be done really carefully. And by the way, congratulations to those of you who are considering them now, because a lot of people are kind of waiting for the taxes to go up, blah, blah, blah. Well, it doesn't look like taxes are going to be going up. This is one of the reasons we tell you take tax law as it is today. But I think that's an excellent answer. And again, I still think you'd be a good candidate to sit down with an advisor, probably pay somebody to write the plan and figure all that out for you.
Yep, I agree.
All right, what else we got? We got any more?
We've got one more.
All right, let's do it.
This is from Keith in Orlando, Florida. Hi, guys. First of all, many thanks for everything you do for us regular investors. My question is about something I've heard you guys say on more than one occasion. ETFs are more tax advantageous than their mutual fund counterparts. Can you explain why this is so? One thing I think I've heard you say is that when a mutual fund pays dividends, it's taxable, but so what? Wouldn't the equivalent ETF also have a similar earning that would then be needed to distribute to investors, which would in turn be taxable? Or am I missing something? Many thanks for any clarification you can help with.
All right, this is pretty easy. So first of all, exchange-traded funds are more tax efficient because of the way they are constructed. Generally, inside of if a mutual fund needs to generate cash, it sells actual securities, stocks, and if those stocks had gone up for some period of time, then the people who are in the fund pay the capital gain. Vanguard had a big problem with this just a few years ago and just paid a big settlement as a result of it. So inside of that fund, they're creating these capital gains. It could be, by the way, where you have a down year, not this year apparently, but you have a down year where you actually have to pay tax because of things done inside the fund. Exchange traded funds. Remember the name, exchange. They're simply exchanging securities in there, not generating those capital gains. I went back and looked out of curiosity. I went and looked at an exchange traded fund study. They found with one particular fund, Emerging Markets Fund, that the net asset value was reduced with a mutual fund by 6.5%, whereas an exchange-traded fund with the same holdings was only reduced by 0.1 because of the capital gains treatment. But it's capital gains, not dividends, which is an important thing to know. The other reason exchange-traded funds have been better, more tax efficient is if you buy the right ones and they're sort of passive or rules-based, they're not moving money around very much, right? Whereas people that run actively, the ARC and other active management, they don't care. That their job's not to pay attention to taxes. It's to make money, which I think she must be making money this year. But the point of the matter is those two are the reasons. You don't really get a break, though, on the dividend part, correct?
Mm-hmm. Absolutely. So dividends and interest, that's something that you can't really control. And keep in mind, too, this is only talking about taxable accounts. If you've got, mutual funds and you're worried about switching over to ETFs, you don't necessarily have to in your retirement accounts, although you may want to for other reasons like lower costs and better exposure to different things. But if you're in your taxable account, you're still going to have interest and dividends. But this is just saying that those capital gains distributions that show up on your 1099 are going to be a little bit lower year to year. Doesn't mean you won't have to pay capital gains when you go and sell the fund.
Correct.
But generally speaking, they'll be lower than you'll see with mutual funds.
Yeah, they have been. And I suspect they will continue due to the construction. So thank you for that. And right now, our portfolios are all exchange-traded funds. I think we've mentioned this on the podcast that I suspect in the next 10 years, it's going to be very hard on the mutual fund industry. And a lot of this comes down to marketing, right? I mean, if you get a hot mutual fund, people might say, I really got to be in the mutual fund. But you look at the major firms, the Vanguards of the world, the Dimensional funds, the Avantis, I know they're small, but all the big guys now are finding a way to take the same style that they have in a mutual fund and turning that into an exchange-traded fund or directly doing it so they can make it available because people have said, wait, I want to be in that new cool thing called exchange-traded fund, so I got to move over there. Sometimes it makes sense, sometimes it doesn't. But for reasons of taxation, it is truly a better deal. Speaking of a better deal, you know what's coming up just in a couple months because you're going to be up on the big stage. Oh, I saw beads of sweat there on her young brow for just a moment. You're going to be speaking at Retire Meet 2025. That is February 8th. You can sign up for either the in-person in Bellevue or the online version. We will sell out the Bellevue event again because we've done it for 10 straight years. What are you going to be talking about at Retire Meet 20? Or do you even remember? You're so busy.
I remember. We're talking about investing for the next generation. So, it'll be really interesting to go through how younger folks should really be thinking about investing or possibly grandparents and parents be thinking about setting up their kids and grandkids. So it'll be a good topic.
That's going to be awesome. So thank you for doing that. She'll be speaking that day. I'll be doing a little chat. Don will be there. Paul Merriman will be there. Joe Salsehai from Stacking Benjamins will be there. We've got advice on estate plans, on Medicare. Paul Lupescu from Dimensional Funds, always excellent. That is all on one stage. As I said, if you want to come to Seattle, if you're outside of Seattle, you don't want to, if you just want to get that vacation here in February, a lot of people do, because, you get tired of all that sunshine from the Southwest. I need a little rain in my life. Okay, I'm kidding. You can join us in Bellevue, but also online. And the online version has a very small nominal charge that goes to charity. The in-person has a little more because we got to pay for all the food. There's breakfast, there's lunch, etc. So go to retiremeet.com, and you can sign up for the next big event, February 8th, 2025 in Bellevue. We would love to see you then. We'd love to see you back on this podcast again, Roxy. You did a great job.
Yeah, I look forward to it.
You're fantastic. Some of you have written and said, I want to talk to Roxy. She's one of our great advisors. She'd be terrific to talk to if you need help in any other way or want to send us a question. Pretty easy just to go to talkingrealmoney.com. And by the way, if you ever show up at the office here in Bellevue, you'll see us all working away and talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Apella Wealth, a fee-only registered investment advisor. Please see Apella Wealth's ADV Part 2A on our website for information regarding Apella's fees and services. Apella Capital, LLC, DBA Apella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Apella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.